To keep yourself updated, subscribe to Indigolearn and click the bell icon and download our app OneFin to start learning on the go.
So let's have a look at a question from November 22 examination on income tax. Pretty simple, just we need a logical approach to solve it. Following is the summarized statement of profit and loss for New Age Limited as per Ind AS for the year ended 31st March of 22. So you have revenue from operations 1450, other income 700, then you have total income of 1520, basically summation of these two. Then purchases of stock in trade, changes in inventory, employee benefit expenses, finance cost, other expenses. So 770 is the total expense. So 1520 minus 770, you have profit before tax of 750, current tax expense 211.65, profit after tax 538.35. This is the P&L, right? Now consider the following additional information, that the income tax applicable to New Age India Limited is 30%. So 30% is tax payable, but if you see 750 into 30%, it works out to 225, but it is only 211.65. Why is the case? That is the case because income as per income tax or taxable income as per income tax would be different from the income we report in the financial statements, right? So those are the items which will cause the difference. Other expense include the following expenses which are not deductible for income tax purpose. So you have some expenses which are not deductible for income tax purposes. Now that expense you have already included here. So when you calculate the taxable income, you will add back, right? So penalties 1.5, donations 55, impairment 7 lakhs. Other expenses also include expenditure on scientific research amounting to rupees 10 lakhs, in respect of which 150% deduction is available under income tax. So there is an expense of 10 lakhs, but for tax purpose, you will get a deduction of 150%, that is 15 lakhs. Then other income includes dividend of rupees 5 lakh, which is exempt from tax. So no tax is payable. Long-term capital gains of 12 lakhs, which are taxable at the rate of 10%. Here we have average rate is 30% or actual taxable bracket is 30%. For capital gains, it is only 10%. Profit before tax of rupees 750 lakhs includes agricultural income of 65 lakhs, which is exempt from tax. So on this also, tax is not payable. Now one thing you have to keep in mind is, those 65 lakhs, we are saying, it is exempt from tax and all of that, but it is a case of a company. So now here, agricultural income of rupees 65 lakhs, then profit before tax of 750 lakhs includes agricultural income of 65 lakhs, which is exempt from tax. So agricultural income is exempt from tax to the extent of 65 lakhs as this question is concerned. Don't mix this up with your income tax provision. There is agricultural income, partial integration, this and that. Ignore all of that. Here for this question, it is fully exempt. And profit of 75 lakhs earned in the US, on which New Age Limited has paid tax of 20%. So on 75 lakhs, they have paid tax at the rate of 20% only. So these are all the items which we have to consider while calculating tax expense, right? What is the question? During the review of financial statement, the CFO multiplied the profit before tax by the income tax and arrived at 225 lakhs as the tax expense. However, the total actual income tax expense appearing in the summarized statement of P&L is 211.65 lakhs. You are required to help the CFO of the company in reconciling the difference between tax expense amounts. So what the CFO has done, the CFO has said total income as per P&L is so much, into 30% tax should be 225. Why is the tax only 211.65? You have to help him reconcile the difference between the tax expense amount. Now here the requirement of the question is not to calculate taxable income and tax thereon. Here you have to say for the accounting purpose, or for here you have to calculate saying that for accounting income, if you apply 30%, it is 225 lakhs. What are the various items which will result in difference, and how can we arrive at 211.65 lakhs, right? So a very simple question. Let's get on to solution of this. So now what are we required to do? We are required to reconcile the tax expense on the accounting profit if you apply 30% and the actual tax expense. So what we'll do is we'll take here, income, whatever is the income, tax rate. Here we will take the income and tax part. Okay. So what are we doing here? We are reconciling the tax expense. Please remember, you are not required to take the taxable income or calculate the taxable income and calculate the tax on that. That is not the requirement of the question. Requirement of the question is to reconcile the tax, in which I will be doing in this particular column, that is the tax column. This income part reconciliation I am doing so that you understand the linkage. Okay. So in the examination, you are only required to reconcile the tax and not the income, right? So now profit before tax as given is 750 lakhs. Tax on that is 750, or I'll have one more column for tax rate, 30%. So if it is 30%, tax is 750 into 30%, 225. Now how this 225 can be seen as 211.65? That is what we need to do. Profit before tax is 750. On that, tax at 30% will be 225. But then how did it become 211? So we have to basically move from 225 to 211. Now by using what? By using all this information. Other expense include the following expense which are not deductible for tax purpose. If it is not deductible for tax purpose, what will you do for income tax purpose? You will add back. That means you will increase the tax part, right? So add expenses not allowed. Number 1, penalties 1.5 lakhs. 2, donations 55 lakhs. Now don't get into think that, sir, this donation, ATG deduction and all of that. Income tax knowledge, keep it aside, because here they have given specific information as per the question. 3rd, impairment of goodwill, that is 7 lakhs. So all of these are not deductible. Now if these are not deductible, what will happen to your tax? Tax will be higher. So if you apply the 30% tax rate, these will be higher. 1.5 into 30%, 0.45, 16.5 and 2.1. So this is the tax impact of expenses not allowed, which is coming to 19.05 lakhs, right? Now this is the tax impact of expenses not allowed. Moving on, second category, other expenses include expenditure on scientific research amounting to 10 lakhs, in respect of which 150% weighted deduction is available. Means what? You will get extra deduction of how much? 5 lakhs, which will reduce our tax expense. So weighted deduction, scientific research, how much? 5 lakhs you will get extra deduction. This will reduce our tax. So you will reduce this. Tax impact is again 30% and the net impact here is 1.5 lakhs. Okay, so tax impact of extra deduction is 1.5 lakhs. So this is the first component. This is the second component, right? Then other income includes dividend of rupees 5 lakhs which is exempt from tax. So dividend income. How much is the dividend income? Dividend income is 5 lakhs. So 5 lakhs is the dividend income. 30% of 5 lakhs will increase your tax by 1.5. Then dividend income is 5 lakhs and the tax impact of this is 1.5 lakhs. This will reduce because it's an exempt. Income will be reduced and tax will also be reduced. Then second, there is one more exempt income which is agricultural income of 65 lakhs. So agricultural income of 65 lakhs will reduce our tax by 30%, which is 19.5 lakhs. So tax impact of exempt income is 21 lakhs, which is the third component, right? Then long term capital gains of rupees 12 lakhs are taxable at 10% and profit of 75 lakhs earned in the USA have a tax rate of 20%. Now these are not differences in income, these are differences in taxation. So the next component is, because you have to pay less tax, tax impact of difference in rates. Okay. Now what is that part? First part is LTCG. Now LTCG, the income is 12 lakhs. On this we don't have to pay 30% tax. On this we don't have to pay 30% tax. How much tax do we need to pay? We need to pay only 10% tax, which means we are paying 20% tax less. So you will have minus 20% of that impact. So the impact of this will be minus 2.4. It will reduce your tax liability. Second, US income. US income, the question says 75 lakhs earned in US on which tax is paid at 20%. So 75 lakhs earned in US, tax paid at 20%. We are not paying 30%. So here there is a tax saving of 10%. So the impact is 7.5. So tax impact of difference in rates is 2.4 and 7.5, that is 9.9. This is D. So tax expense as per income tax is 225 plus 19.05 plus minus 1.5 minus 21 minus 9.9. So it comes to 211.65. This is the reconciliation. Now, if you reconcile the income also, taxable income is how much? Sum of all the 750, all these adjustments you will take and you will calculate the taxable income. You will not take this 12 and 75 because these are difference in tax rate. So your taxable income is 738.5. Now on this, tax on special rates income, one is LTCG and US income tax, US income 12 and 75, tax rate is 10%, 10% and 20%. So the tax amount is 12 into 10%, 1.2, and 75 into 20%, 15. Then other income at 30%, that is 738 minus 12 minus 75, you get 651.5. On this 30%, if you apply, you get 195.45. If you sum this up, you get 211.65, right? So basically you are required to prepare this statement, this format if you follow, income tax rate and tax, or directly calculate the tax, but you have to give the working 750 into 30%, 1.5 into 30%, like that if you do, it would be more than sufficient. Let's now have a look at another question. This is based on financial instruments related to guarantee. This was asked in November 22 examination and also was a part of May 21 RTP. Okay, very interesting question and not there in the study material as of today, and it's good that we solve this question. On 1st of April of 21, Fortunate Bank has provided a loan of 25 lakhs to Mohan Limited for 4 years at 10% per annum, and the loan has been guaranteed by Surya Limited, which is a holding company for Mohan Limited. So Surya Limited is the parent company of Mohan Limited. Interest payments are made at the end of each year and the principal is repaid at the end of the loan term. If Surya Limited had not issued a guarantee, Fortunate Bank would have charged Mohan Limited an interest rate of 14%. Surya Limited does not charge Mohan Limited for providing the guarantee. So now here what has happened is, you have one entity which is Surya Limited, then you have Mohan Limited, and then you have the bank. Okay. Bank has given a loan to Mohan Limited at 10%, for which Surya Limited has given a guarantee. Now what happens under a guarantee? If at all in the future Mohan Limited fails to pay to the bank, Surya Limited will have to pay the amount to the bank. That is what is the guarantee about. And because the guarantee has been given, bank has a better security. And because bank has a better security, bank has said, okay, instead of 14%, we will charge you only 10%. Now, by providing this guarantee to the bank, Surya Limited is providing some kind of indirect benefit to Mohan Limited. What is that benefit? See, if I had taken a loan at 14%, my interest would have been, let us say, 14,000. But because I am taking at 10%, it will be 10,000, assuming a 1 lakh rupee loan. Okay. So this is the benefit that is provided to Mohan Limited by Surya Limited. And Surya Limited does not charge anything. Normally, if you ask someone to give a guarantee, or if you go to a bank for a guarantee, bank will charge because you are taking a risk. Here, Surya is taking risk. Surya is not charging anything from Mohan Limited. But then we know that financial guarantee contracts have to be measured at fair value. They have to be recognized at fair value. Now the question comes, what is the fair value? Question is, what is the fair value? Now the fair value in case of a guarantee contract is determined considering the interest savings. If guarantee was not given, interest would have been higher. Because guarantee is given, interest is lower. So assume again a 1 lakh loan. I know the loan amount is higher, but assume 1 lakh loan. Think of it from the point of view of Mohan Limited. Without guarantee, on a 1 lakh rupee loan, you should have paid 14,000. With guarantee, amount payable is only 10,000. So, this 4,000 is the net benefit or net savings for Mohan Limited. And please remember, Mohan Limited is a subsidiary. Maybe if it was any other party, Surya Limited would have charged something or would not have provided guarantee. But here, because it is, Mohan, because it's a subsidiary, they have got a benefit of 4,000 because of the guarantee. So this 4,000 per year that is saved, which is discounted at applicable rate of interest, that will give us the present value of benefit, which is the fair value. So Surya Limited is indirectly giving benefit to Mohan Limited of what? Of present value of the interest saved. That component is considered to be a benefit which is provided to the subsidiary, and Surya Limited will say this amount, whatever is the fair value, that is my investment. That is my investment, and corresponding to that investment there is also a liability. Why liability? Because you have to pay. You have to pay the amount in case of default. So now for Surya Limited, there is an obligation towards bank, okay, which is a guarantee. This will be accounted for at fair value, and correspondingly whatever is the benefit provided to Mohan Limited, you will account for it as investment in Mohan. Otherwise, what would have happened is, the holding company, if they would have charged something, then they would have received money. They would have received money. That money they have not received. So indirectly it is like putting an investment. Otherwise, they would have received that money and maybe they would have invested. So think of it that way, right? So now, having understood this, let us look at the solution. So now here, a financial guarantee contract is initially measured at fair value. This we have already understood in the class as well, and the fair value is either the transaction price if available, or otherwise present value of benefits under the guarantee. Now here what we need to do, we need to calculate the benefit. So what is the benefit? For 4 years there is a 4% interest saving. So 1, 2, 3, 4. Loan amount is 25 lakhs. 25 lakhs, 25 lakhs, 25 lakhs. Interest at 14% is 3,50,000. Interest at 10% is 2,50,000. So what is the benefit? 350 minus 250, 1 lakh is the benefit. What is the present value factor at 14%? 1 divided by 1.14. This divided by 1.14 and 1.14, 1.14. Present value of benefit is 1 lakh multiplied by 0.8772. Now there could be a difference, so let me just punch it up. 0.8772, 0.7695, 0.6750, 0.5921, and the present value of benefit is 1 lakh multiplied by this number 87720, 76950, 67500 and 59210. So the benefit, total benefit is how much? 2,91,380. There can be some rounding of difference here and there. 2,91,380 is the present value of the benefits. Now, this is the present value. So, whatever benefit that the holding company or the parent entity is indirectly providing to the subsidiary is considered as that the holding company has made an investment, because it's an indirect way of consideration. So, in the books of Surya Limited, because Surya has provided the guarantee, so you will say investments, subsidiary is Mohan, 291,380 to financial liability, which is a guarantee, 291,380, and this over a period of 4 years will be amortized, and you will see what is the closing balance each year. Okay. Now, year 1, 2, 3, 4, opening balance 291,380, interest at 14%, which is 291,380 multiplied by 14%, 4793, interest 4793, and 1 lakh of benefit has expired, right? So, benefits expired or provided 1 lakh. So, closing balance would be 291,380 plus 4793 minus 1 lakh, that is 232,173. Then you have opening balance 232,173, add interest at 14%, 32,504, benefit expired 1 lakh, 164,677. So, like this you have to prepare the amortization schedule for the guarantee, right? Closing balance is 15 because of rounding of difference. So, let me just make it minus 15. So, you have interest income what the parent entity will recognize every year, right? This is the amortization schedule. Now what this table basically tells us is, at the end of year 1, the fair value of the guarantee liability comes to 232,173, okay, and the movement from 291 to 232 should be recognized as income. Please remember, on one side we have said there is an investment, and then we have said there might be a liability. That liability is no longer required for the first year. So, to that extent there is a benefit that you will recognize in P&L. Now, if it is difficult to visualize, think of this. Let us say there is a parent, subsidiary, bank. Subsidiary takes a loan from the bank at 10%. Parent gives a guarantee on behalf of the subsidiary, right? For this, for example, subsidiary pays the parent fair value of guarantee. Then what will the parent do? Parent will debit cash, credit liability, correct or not? Because they have got the cash and now they have credited the liability. Now, at the end of year 1, the liability has reduced. So, what will that be? What will that be? That will be a gain. So, every year the movement of liability, whatever is the change in the liability, that will be recognized as a gain. Okay. So, coming back, closing balance, so difference between 299 and 232 is recognized as a gain, but then we have to also see the question which says, on 31st March of 22, there is a 2% probability that Mohan Limited may default on the loan in the next 12 months. If Mohan Limited defaults on the loan, Surya Limited does not expect to recover any amount from Mohan Limited. So, 2% is the probability that Mohan Limited will default. So, what is the expected loss? Expected loss is 25 lakhs into 2%, which is 50,000. Okay. Now, if 50,000 is the expected loss and the liability we are saying is 232, what is the carrying amount? Carrying amount will be higher, which is 232. So, income will be recognized considering the opening balance minus the carrying amount. You will say 59,207 is the income. So, on 31st of March of 22, you would say debit financial liability by 59,207, credit P&L or income statement 59,207, or you can say financial liability to P&L, that is also fine. Okay. Then second year, what is the probability? 4% probability that Mohan may default on the loan in the next 12 months. Again, if they default, nothing is recoverable, so entire loss will be on our side. So, 4% default, expected loss is how much? 4%. So, 1 lakh, but our liability is anyways higher, so we will recognize it at the higher amount and the difference will be recognized in income. So, for 31st of March of 23, you would say debit financial liability 67,496 because we are reducing the financial liability, and credit P&L 67,496. Then year 3, 24, there is a 5% probability that Mohan Limited may default on the loan in the next 12 months. Again, no amount is recoverable. So, now the default is 5% expected, which is 1,25,000. So, the carrying amount now will be 1,25,000 and the income will be only 39,677. So, for 31st March of 24, financial liability you will reduce by 39,677 and you will credit P&L by 39,677. So, this is how we can solve this type of question, and if you follow the structured approach, there will not be any challenge in the examination.